Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the money world. And sometimes things just go down the drain, don't they? Let's dive into Cable One's latest quarterly report and see what's cooking in their business, especially with some big financial shifts happening. This report is for the period ending June 30, 2025 from Cable One Inc., a company that provides internet cable and phone services across many states. Looking at their balance sheet, which is like a snapshot of what the company owns and owes, we see some interesting changes. They have about $1.78 billion in property, plant, and equipment. This is the stuff they own, like cables and equipment. Then there are intangible assets, which are things like brand names or patents that aren't physical. These are worth a lot, around $2 billion, but they've gone down from over $2.5 billion at the start of the year. And then there's goodwill, which is created when a company buys another company for more than the value of its identifiable assets. This has also dropped from about $930 million to $840 million. Overall, their total assets have decreased from about $6.5 billion to $5.7 billion. On the other side of the balance sheet, their short-term debt, the part that's due soon, has jumped up significantly from about $18 million to nearly $600 million. Now for the part that usually shows how much profit a company has held onto retained earnings. This has fallen quite a bit from about $1.7 billion at the end of last year to $1.25 billion. This big drop hints that the company might have had a tough quarter. Let's look at how they actually made or lost money. Their total revenues for the 3 months ended June 30, 2025 were $381 million, which is a drop from about $394 million in the same period last year. But the big story here is this massive $586 million asset impairment. This means they've had to write down the value of some of their assets because they're worth much less than they thought. This is a huge non-cash charge, meaning it's not actual money spent, but an accounting adjustment that hits their profit hard. Because of this asset impairment, their operating income has gone from a profit of $110 million last year to a loss of almost $489 million this quarter. And the bottom line net loss is a staggering $438 million for this quarter, compared to a profit of $38 million last year. That's a massive swing. When we look at their average revenue per user, or APRU residential data, APRU actually went up by 2.4% to $81.23, and residential video APRU also increased by 4.2% to $62.52. This is good for those services, showing they might be getting more revenue from each customer. However, even though APRU went up for data, the total revenue from residential data actually went down slightly by about $1.1 million. This means they have fewer data customers overall, even if the remaining ones are spending a bit more. Residential video revenue took a big hit, down $18.6 million or nearly 16%. This is a clear sign that fewer people are subscribing to their video packages. Now, let's talk about adjusted EBITDA, which is a way companies measure their performance before considering certain expenses. For the 3 months ended June 30, 2025, it was $2,003 million last year. This shows that even before those big impairment charges, their core business performance wasn't as strong. They spent about $68 million on capital expenditures, which is money spent on things like improving their network. This is slightly less than the $71 million they spent last year, a small decrease. Looking at cash flow from operations, it went down from about $320 million last year to $261 million this year. This means they generated less cash from their day-to-day business activities. Investing activities also used up more cash, going from about $162 million to $130 million. This drop might seem good, but it's mainly because they spent less on buying things like businesses or equipment compared to last year. Financing activities, which includes things like paying back loans or issuing new ones, used up $141 million this year, down from $146 million last year. This reduction seems to be due to them cutting their dividend payments. Interestingly, they haven't bought back any of their own stock in the first half of this year or last year, despite having a plan to do so. And a big move, they've suspended their quarterly cash dividends. This is a significant change that saves them about $67 million a year. They plan to use this money for paying down debt and investing in growth. Now let's talk about those asset impairments. They had to write down a huge chunk of their intangible assets and goodwill. This means the value they assign to things like franchise rights and the goodwill from past acquisitions is no longer considered valid. The company explained this was because their stock price dropped, which is a signal that the market values the company less. This also means their business might be facing tougher times than they initially thought. There's also a leadership change on the horizon. Their CEO is retiring at the end of this year and they are actively searching for a new one. This transition is really important. A smooth handover with the right new leader is crucial for managing the company through these challenging financial times, especially with the significant impairments and strategic shifts. So what's the story here? Cable One is clearly navigating a tough period. They're seeing customers drop off from video and voice services, which is hitting their overall revenue. The massive asset impairments signal that their previous valuations were too optimistic, likely due to increased competition and perhaps overpaying for past acquisitions. While their data services are holding up reasonably well with customers spending a bit more, it's not enough to offset the declines elsewhere. The decision to suspend dividends shows a focus on conserving cash and managing debt, which is a prudent move given the circumstances. The leadership transition adds another layer of uncertainty. In my opinion, Cable One is facing significant headwinds. They're trying to pivot towards higher margin data services, but the market is clearly pushing back, reflected in the stock price drop and resulting impairments. The company's future really hinges on how effectively they manage their costs, grow their high-speed internet customer base, and successfully navigate this leadership change. It's a challenging environment for sure. Alright, that's our breakdown of Cable One's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more discussions. Thanks for watching. See you next time.